All of you in this room have the brains to do extremely well in life. You've all got the energy to do extremely well in life. And then the question is, how do you apply it? If you've got a 200 horsepower motor, do you get 200 horsepower out of it? Do you get your full potential, or do you get 100 horsepower or 50 horsepower?
In this video, I'll explain a powerful investment strategy that can turn your $30 per week into $6,000 monthly dividend income. We'll cover the mechanics behind this strategy, how it works in real life, and why it's so effective. In the end, I'll reveal how using this strategy can grow your $30 per week investment into a portfolio worth over $1.3 million, generating $6,000 in monthly dividends. So our goal here is to create a substantial income stream with a modest weekly investment of $30. To achieve this, we will utilize the Dividend Reinvestment Plan, commonly known as DRIP. This strategy involves reinvesting dividends earned from stocks back into purchasing more shares, rather than taking them as cash. This reinvestment creates a cycle of growth where each reinvested dividend generates more dividends, allowing your investment to grow exponentially over time. Let's break down how DRIP works. When you own shares in a company that pays dividends, you receive a portion of the company's profits based on the number of shares you hold. Instead of taking these dividends as cash, DRIP reinvests them to purchase additional shares of the stock. This means that the number of shares you own increases with each dividend payout, leading to more dividends in the future. One of the main advantages of DRIP is the power of compounding. Compounding occurs when the earnings from your investments generate their own earnings. With DRIP, the dividends you reinvest to buy more shares, and those shares in turn generate more dividends. Over time, this compounding effect can lead to significant growth in your investment portfolio.
And you put $1 million into the S&P 500 at that time and reinvested it. During my investing lifetime, that million would have turned into $5.3 billion. You would have gotten, for every dollar you put in, you've gotten over $5,000 without ever reading a headline, an annual report. You didn't have to know accounting. You just had to believe in America.
For example, suppose you invest in a stock worth $30 per share and you buy one share every week. If this stock pays an annual dividend of $1 per share, after 1 year, you would have approximately 52 shares and you would receive $52 in dividends. By reinvesting those dividends, you purchase more shares, which in turn generate additional dividends in the following year. This creates a snowball effect, where the growth accelerates over time.
That was all we could handle in those days. So the snowball is, it's built up as it's gone down the mountain. And we hope there's a lot of mountain left and a lot of wet snow, and we're looking for it.
Additionally, DRIP provides a disciplined approach to investing. By reinvesting dividends automatically, you are consistently adding to your investment without the need to manually reinvest. This not only simplifies the investment process, but also ensures that you are continuously building your portfolio. Another critical advantage of the DRIP strategy is dollar cost averaging. This investment approach involves regularly purchasing shares regardless of the market's ups and downs. By investing a fixed amount, like $30 each week, you buy more shares when prices are low and fewer shares when prices are high. Over time, this helps to smooth out the fluctuations in the market, leading to a lower average cost per share. Dollar cost averaging reduces the risk of trying to time the market, which can be unpredictable and stressful. Instead of worrying about the best time to invest, you consistently invest your set amount, allowing you to benefit from market dips without the fear of making a wrong investment decision. This strategy also helps to avoid the emotional pitfalls of investing, such as panic selling during market downturns or over-enthusiastic buying during peaks. Let's illustrate this with an example. Suppose you invest $30 every week in a stock. In some weeks, the stock price might be $25, allowing you to buy 1.2 shares. Other weeks, the price might be $35, and you'll buy about 0.86 shares. Over a year, you might purchase more shares during the lower-priced weeks and fewer during the higher-priced weeks. This averaging process helps stabilize your investment cost, reducing the impact of market volatility. In addition to stabilizing your investment cost, dollar cost averaging ensures that you are consistently building your portfolio. By maintaining a regular investment schedule, you continuously add to your holdings, which is essential for long-term growth. To sum up, dollar cost averaging allows you to invest consistently, smooth out market fluctuations, and avoid the pitfalls of market timing. This disciplined approach is key to maximizing the benefits of the DRIP strategy. One of the most appealing aspects of the DRIP strategy is the convenience of automatic investment, which I have talked about earlier, but now let's go into details. Once you set up a DRIP with your broker, your dividends are automatically reinvested to purchase additional shares. This automation means that you don't have to manually reinvest your dividends, which simplifies the investment process and ensures that your investment strategy remains consistent. Automatic investment is particularly beneficial for those who prefer a hands-off approach to investing. It removes the need to regularly monitor your portfolio to reinvest dividends, making it easier to stay committed to your long-term investment goals. This streamlined process allows you to focus on other aspects of your financial planning while your investments grow steadily in the background. Moreover, automatic investment helps maintain discipline in your investment strategy. By reinvesting dividends automatically, you ensure that your money is consistently working for you, maximizing the growth potential of your portfolio. This disciplined approach is essential for long-term success, as it prevents the temptation to spend dividends on short-term desires rather than reinvesting them for future growth. Setting up a DRIP with your broker is usually straightforward. Most brokers offer this service, and once it's established, the reinvestment process occurs seamlessly. Each dividend payment is used to purchase additional shares, contributing to the compounding growth of your investment over time. To maximize the benefits of the DRIP strategy, consider supercharging it by increasing your regular contributions. By investing more than just your dividends, you can accelerate the growth of your portfolio significantly. For this discussion, let's use the example of investing $30 per week, which amounts to $1,560 per year. Increasing your contribution allows you to purchase additional shares more frequently, enhancing the compounding effect. When you add more money regularly, not only are you buying more shares, but you're also enabling those shares to start generating dividends sooner. This means your portfolio will grow at a faster rate, as each new share contributes to the overall dividend payout and subsequent reinvestment. Let's break down how this works. Suppose you invest $30 per week in a diversified portfolio. Over time, your consistent contributions, combined with reinvested dividends, creates a powerful compounding effect. For example, if your portfolio averages an 8% annual return, your $30 weekly investment could grow to over $127,000 in 20 years, thanks to the power of compounding. Regularly adding to your investments also helps you take better advantage of dollar cost averaging. By spreading out your purchases, you reduce the impact of market volatility and stabilize your investment costs over time. This approach not only boosts the growth of your portfolio, but also reduces the risks associated with market fluctuations. Furthermore, increasing your contributions fits well into most budgets without requiring significant lifestyle changes. Setting aside $30 each week is manageable for many, and the long-term benefits far outweigh the short-term sacrifices. Selecting the right stocks is important for a successful DRIP strategy. The effectiveness of your investments heavily depends on the quality and stability of the companies you choose. Here are the key categories of stocks to consider: blue-chip dividend stocks, dividend aristocrats, high-yield dividend stocks, and growth-oriented dividend stocks. Blue-chip dividend stocks are reputable companies with a long history of consistent dividend payments. These stocks provide a stable foundation for your portfolio. Companies like Coca-Cola and Johnson & Johnson are examples of blue-chip stocks that offer reliability and steady growth. Dividend aristocrats are companies that have increased their dividends for at least 25 consecutive years. This category includes firms like AT&T and Walmart, showcasing a strong commitment to returning value to shareholders. These stocks are ideal for long-term investors seeking stability and regular income. High-yield dividend stocks, such as Realty Income Corporation, offer higher-than-average dividend yields. While these stocks may carry more risk, they provide significant income, making them attractive for income-focused investors. Growth-oriented dividend stocks combine capital appreciation with dividend income. Companies like Microsoft and Apple fall into this category, offering the potential for significant growth along with regular dividends. By selecting stocks from these categories, you can ensure a balanced and resilient DRIP portfolio. With the principles of DRIP and the categories of stocks in mind, let's build a sample portfolio and analyze its potential. In the end, I'll reveal how using this strategy can grow your $30 per week investment into a portfolio worth over $1.3 million, generating $6,000 in monthly dividends. By diversifying your investments across blue-chip dividend stocks, dividend aristocrats, high-yield dividend stocks, and growth-oriented dividend stocks, you can create a balanced portfolio designed for steady growth and income. For our sample portfolio, we'll select stocks like NextEra Energy, Starbucks, Abbott Laboratories, Home Depot, and the ProShares S&P 500 Dividend Aristocrats ETF. NextEra Energy, a leader in clean energy, offers a current dividend yield of 2.76%, a dividend growth rate of 10.98%, and an annual share price appreciation of 11.98%. Starbucks, a global coffee giant, provides a dividend yield of 2.01%, a dividend growth rate of 16.69%, and an annual share price appreciation of 8.72%. Abbott Laboratories, a healthcare innovator, has a dividend yield of 1.42%, a dividend growth rate of 12.5%, and an annual share price appreciation of 10.31%. Home Depot, a leading home improvement retailer, boasts a dividend yield of 2.47%, a dividend growth rate of 17.91%, and an annual share price appreciation of 16%. Finally, the ProShares S&P 500 Dividend Aristocrats ETF, which focuses on dividend aristocrats, offers a current dividend yield of 2.04%, a dividend growth rate of 20.48%, and an annual share price appreciation of 8.17%. By averaging these metrics of these selected stocks, we get a current dividend yield of approximately 2.14%, a dividend growth rate of 15.71%, and an annual share price appreciation of 11.04%. If you invest $30 each week into this portfolio, your annual contribution would be $1,560. With the power of DRIP and consistent contributions, your investment can grow significantly over time. For example, after 10 years, your portfolio could potentially grow to approximately $26,000. After 20 years, this could grow to around $127,000, thanks to the compounding effect and reinvested dividends. By carefully selecting a mix of reliable dividend stocks and consistently investing, you can build a robust portfolio that not only grows in value, but also generates substantial income over time. Understanding the potential of long-term growth is essential when leveraging the DRIP strategy. By consistently investing $30 each week, you create a disciplined approach that maximizes the benefits of compounding and dollar-cost averaging. Over the long term, these small, regular investments can lead to substantial growth in your portfolio. Consider the same scenario where you invest $30 every week into your diversified portfolio, amounting to $1,560 annually. Assuming an average annual return of 8% and reinvesting dividends, the power of compounding significantly boosts your investment. After 10 years, your regular weekly investments could grow your portfolio to approximately $26,000. Extending this to 20 years, your portfolio could reach around $127,000. To achieve a substantial monthly income of $6,000 in dividends, let's extend our projection to 40 years. Assuming the same annual return of 8%, your consistent contributions, combined with compounding and reinvested dividends, could grow your portfolio to over $1.3 million. With an average dividend yield of 6%, this portfolio would generate approximately $78,000 annually in dividends, resulting in a monthly income of $6,500, which is $500 more than our original goal. This long-term growth is driven by the consistent reinvestment of dividends and the steady appreciation of stock prices. The power of compounding means that your portfolio is working harder for you, with each reinvested dividend generating more shares, which in turn generate even more dividends. This continuous cycle of growth highlights the importance of patience and consistency in investing. To break it down further, after 30 years of investing $30 per week, your portfolio would be substantial. But to reach the $6,000 monthly dividend goal, you would need to continue for an additional decade. This extended period allows your investments to compound significantly, reaching the target portfolio size that can provide the desired income. By maintaining a disciplined approach and consistently reinvesting your dividends, you maximize the potential for long-term growth. Each reinvested dividend accelerates the growth of your portfolio, bringing you closer to your financial goals. This strategy requires patience, consistency, and smart stock selection, but the long-term rewards are well worth the wait. What other investment strategies have you found effective, and which stocks are you considering for your DRIP portfolio? Let's discuss in the comments below.